Welcome back, everybody, to my step-by-step series on buying a home. Today, we're going to look at mortgage loan insurance. And the reason we're looking at mortgage loan insurance, because the majority of people who purchase a home put down a down payment of less than 20%. And when you do, then mortgage insurance is required. The most common insurance provider that you're going to hear about is CMHC, the Canada Mortgage and Housing Corporation. They're not the only one in town. Genworth Canada also exists, and Canada Guarantee also exists, and they have slightly different criteria. And your mortgage representative is going to apply the appropriate one for you, depending on your circumstance. What is the purpose of having this? Well, it's intended to protect lenders from loss due to a default from a borrower. So because you have put down less than 20%, you may have put down only 5%, for example, or 6%, then the way that that's viewed is if you don't have as much skin in the game, you have borrowed a lot from a lender. And so they want to protect themselves from a potential default from that borrower or you. And that is what this insurance is all about. Now, the insurance is added to the mortgage, so you won't necessarily see it or even feel it much because it just becomes incorporated as part of your monthly mortgage payment. However, there is an 8% provincial tax that is added, and that is not added to the mortgage. It is a part of your closing costs. I did do another video on one of the most misunderstood things about purchasing a home, and that's the fees involved. And so you can look at that video, and I talk a little bit more about this. The other thing that is also looked at is the GDS, which is the gross debt service ratio. It's not to exceed 35%. And then also the total debt service ratio, not to exceed 42%. Once again, I have talked about those in a previous video. You can go back and look at those to understand them a little bit more. Your credit report is drawn up. So they will order a credit report from you. CMHC uses a credit score minimum of 680. Some of the other providers do use others, scores that are a little bit lower, and your mortgage representative will direct and apply that one accordingly. But what is going to happen is a credit report is going to be drawn, and the whole credit report simply is a financial history, a record of your borrowing of funds and how you have done to pay that back. Have you been consistent with it? Have you paid it back? Have you paid back minimum fees? How much have you borrowed? All that kind of stuff. And then there's a score attributed to that based on how you have fared and how well you have done to pay back any debts. And so the higher the score, the stronger the borrower you are, and the more likely that you are attractive to a lender, and he's more willing to give you a better rate. And so that's how all of that stuff comes into play. Some of the providers of these credit reports are Equifax and TransUnion. You can look those up as well, and you can certainly provide your own credit report. It is important that you examine it to make sure that the information is accurate from time to time. Some things may be missed, or things that should have been taken off are still on the report. And so all of those things are going to obviously affect your credit score. So it is important that that is accurate. So you, at least once a year, you may want to draw a credit report from one of these providers and make sure that everything is accurate. Having a poor credit history, for example, if you filed for bankruptcy, very unfavorable thing to have, and it's going to remain on your record for at least 7 years. And if you have no credit history, then I recommend you start building credit history, because without this, you're not going to have a lender lend you any funds. Certainly not any kind of traditional lender. It really would be some sort of private lender who's going to lend you funds without having any kind of credit history. So it's important. Most simple, easiest way: get a credit card, conventional credit card from one of the big banks, and use it and pay it back. Use it, pay it back. And that's how you're going to start to build a credit history. It's a history of borrowing and paying back funds. Are you doing that consistently? Are you paying back the amounts that you're borrowing? And so I recommend that that's what you do if you don't have a credit history. Start there. The mortgage stress test is another thing that is going to be done. in order to determine how likely a candidate you are to qualify. The set of rules the bank uses, it's not a test to see whether you can handle anxiety or not, but it's a test to qualify you for a mortgage and how much. It's intended to protect borrowers. That's what it's all about. And interest rates obviously have been low and have been historically low. Right now, you can get rates below 2% right now, which we're basically at a point where you're borrowing money for next to free. It's you have no interest or very little interest on the money that you're borrowing at this time. So it is a good time to borrow, no doubt about that. However, things are not going to stay that way. At some point, those rates are going to go back up. And are you going to be able to afford that money you borrowed when we attach those new interest rates that are not 2%, but could be 3%, could be 4%, could be 5%? Can you still afford those payments? And so the bank is going to offer you a credit, an interest rate based on your credit score. However, this rate is not what's going to be used to determine your eligibility. They're going to use a calculation with a higher interest rate to see whether you're eligible to borrow. And so they're going to use the Bank of Canada, a 5-year rate, which is 5.19%, or they're going to use the lender's rate plus 2%. And so as an example I've got here is if you had a mortgage of $400,000 that you were borrowing and you were offered a rate of 2.5%, your monthly mortgage would be $1,790, which is great. However, with the stress test, they're going to do the same calculation of $400,000 with a 5.19% interest rate. Are you going to be able to carry a monthly mortgage of $2,370? Even though that's not going to be your mortgage rate, this is going to be your mortgage rate. They want to know, would you be able to qualify and carry this amount? And if you can, then you will pass the stress test. And that's what this is all about. So when the mortgage representative introduces this, you now know what that's all about. All right, so hopefully that makes sense. But thank you so much for joining me on this video. Please reach out if you're thinking of buying or selling. We'll see you on the next one.